Good morning, folks. This is John Cogan. I'm the CEO of Proformative, the online community for corporate finance, accounting, treasury, and related professionals. First off, I would like to welcome everyone to the webinar, Cap Tables and Equity Tracking. This is one of those subjects that no one trains you on. You usually just find yourself in a position where someone has given you the company cap table or stock plan and says, here, why don't you manage this? That's not a fun place to be, but today I'd like to take some of the mystery out of this for you by telling you a bit about cap tables, how we use them, and how to manage them. I'll give you some examples along the way, and hopefully I can help you understand not just the mechanics, but the hows, whys, and whats of cap tables. As in, why do we do this? What are the things? What are things like option pools and some of these terms that we throw about? How does dilution work, etc. So this is going to be a bit of a presentation using PowerPoint, a little bit of a look at some Excel spreadsheets that I've put together in a sample cap table, and also just a conversation. We typically have sponsors for events like this, but we're doing this one just because we thought it would be useful for folks and a little bit of fun. So I'll give a shout out to all of our users and thank you and them for helping us make Proformative a thriving reality. And with that, we don't have to thank any paid sponsors, so that's easy. A brief note on today's agenda. First, I will run through my presentation, cap table example, and then we'll move into a Q&A discussion where we'll spend the remainder of our time. I'd like this to be an interactive experience for you, so if you have any questions at any time, please go to the questions area in your GoToWebinar control panel and send me your questions. I will do my level best to get to them. And if I don't get to any because perhaps they're too specific or I might not even know the answer, it's entirely possible, then I'll do my darndest to get back to you at a later date, or have someone else, if I can't answer it, have someone else who has the answer get back to you. We will be sending out soft copies of this presentation to all attendees, so you will all get that. We typically get them out the same day. And we'll send not just the presentation, but also the sample cap table in Excel as well. So you'll be getting all of that. If you sign up for CPE credits, great, you'll be in good shape. We'll send you out certificates for that. If you forgot to sign up for CPE credits, then take a quick peek in the chat box. And you'll see I've put an email address in for our events manager. She manages all of our CPE programs, and just drop her an email and she will get you hooked up. With that, why don't we go ahead and start in on today's presentation with a quick introduction to Proformative for those of you who are new to Proformative. We are the largest and fastest growing online resource for finance, accounting, treasury, and related professionals. We reach over 350,000 of these folks every month. And I'll tell you, as co-founder of Proformative, I've been in finance for a couple of decades. And we built this so that folks like you and me can reach out anytime we have questions and talk to peers, subject matter experts, etc., to help us answer those questions. It's a really highly on-point thing. There's no advertising, no self-promotion allowed. It's just professionals talking to professionals. It's a very helpful and valuable resource, and it's a wonderful thing when I see a CFO ask a question and 6 CFOs, 3 controllers, 2 VPs of finance, and an accounting manager all hop in to answer that person's question. That's how it works, and it works very well. So that's a bit about Proformative. Oh, and of course, it's all completely free as well. So this might be your first event, your first exposure, but please feel free to check it out at proformative.com. It's just a great resource, and we're happy to have you use it and hopefully find it useful. Just quickly, the learning objectives for today's events. We'd like you to come away knowing more about cap tables, unsurprisingly, what they do, how they're built, how to build them, how to think about them, a little bit of the whys and wherefores around why we're doing this, and answer some technical questions as well as practical questions about how you manage this. Now, we're not going to be able to get through every possible facet of cap tables in the time we've got today, but we'll do our best to A, give a primer, a good overview, and then B, dive down into the more detailed areas that I have seen in my direct experience be the ones that really trip people up, the things that hopefully will give you the most utility. We're actually going to use some examples right out of Excel. Now, there are lots of programs that help you automate this. There are companies that will manage your cap table as a service for you. But we're actually getting down into the engine room a bit today because that, in my opinion, is the best way to actually learn about what's going on. So we're going to go ahead and get into some of those nitty-gritty details, and hopefully that will help you come away with, once again, not just a mechanical understanding, but a deeper understanding for why are we doing this, how does this stuff work, and then if you want to automate it through a third-party platform later, great, it'll be much easier for you. Moving on. Let's go ahead and hop into the program, and we'll start with a bit of the agenda. We'll start with an overview of cap tables, their major elements. We'll take a tour then of a cap table. We'll run through that Excel spreadsheet, and then we're going to hit a whole bunch of sort of detailed areas. We'll discuss equity forecasting, calculating an option pool, defining what an option pool is, analyzing future equity transactions. So if your company's going to go out and raise more funds, whether it's private market or public market, that has significant implications for your cap table and, by the way, for ownership of shareholders and how much of the company they own, et cetera. We'll get into some of that. We'll take a quick peek at some automated, actually we're not going to take a peek, we'll discuss some automated tracking solutions. And then we'll take a look at some other helpful resources, and then we'll move into the panel conversation. So let's start with cap table overview. Silly question, what is a cap table? Cap table allows you, well, it's a database, essentially, with some sort of viewing mechanism that allows you to take stock of, no pun intended, all classes of stock plus stock options. Companies can have a whole panoply of kinds of stock, everything from common stock to preferred stock to restricted stock units, and it goes on and on. The cap table is where you manage all of this ownership, manage visibility to all of this ownership, track it all, report on all of it. That's why we use cap tables, because boards of directors and executives at companies like to know who owns what stock in this company. You can turn that on its head and ask yourself, how much of this company do I own or do other people own? Your cap table helps you understand all of that, explain all of that, report on all of that, and track it all. Stock option tracking. This is one of the core functions of most cap tables. Stock option tracking is tricky, it's complex, highly detail-oriented, a lot of paperwork that comes with stock options. And if you have a good tracking tool, you can maintain visibility to all of this, visibility to who has what shares, where they are investing, et cetera, et cetera. So it really helps us stay on top of these details, and we'll get more into that later. Reporting on capital structure and options. So once again, how much of our stock is owned by major shareholders, how much of it is common versus preferred, how much of it is stock options which haven't been exercised yet and could be exercised. So those are all things that we use cap tables for, and they're very handy for management reporting. So I know from the registration list, there's a lot of CFOs and VPs of finance on this call. These are the things that your board and your CEO are going to rely on you to help them understand. Let's throw out a little vocabulary here. We'll hit a couple of terms that you'll be seeing on the cap table as we go through it, and they're just good terms to know if you're in a position to be managing this stuff. Common stock. What is common stock? I mean, one thing that I find it really helps when it comes to cap table management is understanding each kind of stock that your company has. Common stock is, once again, no pun intended, the most common kind of stock out there. Typically, common stock has voting rights, so some things that happen at corporations have to be voted on by shareholders. Well, shareholders are typically, well, they could be any class of shareholders, but those with a vote typically are common stock holders. And common stock can frequently be traded on open markets. Sometimes they can be traded on private markets these days, et cetera. But common stock is sort of the baseline entry-level stock of most corporations. considerations. Preferred stock. Different class of stock. It typically does not have voting rights, not in all instances. It depends on the company charter, et cetera. I won't get into those details, but usually does not have voting rights, but it does have other preferential rights, which is why they call it preferred stock, over common stock. For instance, preferred stock typically gets paid out first in a liquidation event. If a company is going Chapter 7, Chapter 11, then preferred stock is usually subordinate to debt, but it's senior over common stock. Typically, when a transaction happens, there's some sort of built-in mechanism that can convert preferred stock into common stock. So, for instance, if there's an IPO, your company goes through an IPO, then typically there's some conversion facility, and preferred stock will convert into common. So at the end of the day, and you'll see this in our cap table, frequently common stock and preferred stock are referred to using some similar high-level terms, like stock outstanding, fully diluted, things we'll talk about later. So remember, that's frequently because when investors and board members think about preferred stock, sometimes they think about it as being an equivalent to common stock once it's been converted. Stock options. Well, when you think about the word option, that usually gives you the right to do something or not do something. And a lot of people, I think, mistakenly think that stock options are stock. They're not. A stock option is an option to buy stock. You may or may not buy it. You may or may not even have the right to do that buying yet. And there's this little thing called vesting, which we'll talk about in a minute, which can restrict that. Frequently, there are restrictions on how and when users can, or owners of these stock options can convert their options into actual stock. We'll talk about a little bit of that shortly. Warrants. Warrants are another kind of stock option. But typically warrants are granted company to company versus stock options are typically granted company to individual, like employee. Employees tend to own most stock options. That's not always the case. You can grant non-employee stock options depending on your stock option plan. If it gives you the right to do that, you could grant stock options to contractors or suppliers. But frequently there's another kind of option called a warrant, which gives typically an entity the right to purchase shares at a particular price at a particular time, which are characteristics of stock options as well, but they're more frequently company to company. An option pool. What is a stock option pool? Well, these options could be shares, and they need to be created by a board of directors, and they need to be accounted for. And the way they're created is that companies will typically create what we call an option pool. So if you know that you're going to hire 100 people in the next year, and that average grant is going to be 1,000 shares of stock, well, you need to essentially create what we call a pool of option shares of 100,000 shares. And then every time you hire someone and give them a grant, you're essentially taking shares out of that pool. So an option pool is created, it's approved by the board of directors, and every time you make a grant, the options actually come out of that pool. And in that way, a company can avoid having to approve brand new shares at the board level every time a new grant is created. Now, and I want to make sure I'm very careful about the words I'm using here. Boards have to approve every option grant, but when it comes to approving the pool of shares that will be granted, that's only done on an occasional, infrequent time scale, and companies will create these large pools of shares which can be used for option grants. That's an option pool, and that has to be in place, that has to be created before you can actually grant individual grants of options. I hope that's clear. Fully diluted shares. Fully diluted refers to all of the shares that could possibly be in your share calculations. So that includes every class of existing stock, which would be common stock, preferred stock, and any other kinds of stock a company has. But it also includes options and warrants on an as-converted basis. So if a company, for instance, has 1 million shares of common stock and 1 million shares of preferred stock, and 1 million shares of stock options, none of which have actually been exercised, so there's still options. They haven't been exercised by the holder yet and turned into actual common shares. Well, you could say there are 2 million shares outstanding, which is the common and preferred stock that's already out there. It's been granted. People, not granted, but purchased or given through the company charter. People have and hold that stock. But what about that other 1 million stock options? Well, that's kind of like potential energy. If they're converted into or exercised, they would be converted into common shares, and then they would be counted as regular stock. So in order to include that in certain stock and cap table calculations, you would use the term fully diluted shares. In other words, every share that could possibly be converted into a real share of stock of any class is included in that fully diluted calculation. So in that example, where we had 1 million shares of common, 1 million shares of preferred, and 1 million unexercised stock options, you would say we have 3 million fully diluted shares. Count every share that could be converted. Grant price, strike price, exercise price. These are all the price, these are just different names at which options, I shouldn't have said shares there, stock options can be purchased by the optionee. And we'll take a look at this when we run through the cap table, but stock options are granted with, we'll just call it a grant price here. And that grant price says, well, we're giving you the stock option at X price today, and in the future, once you've vested, which we'll get to in a minute, you might want to actually own these shares. In order to buy these shares, you would pay the company X dollars or X cents per share, and that's your grant price. So that's something that's set when the shares are granted and approved by the board of directors, and it doesn't change. So for example, if your shares were granted at $1 a share, and let's say you held on to those shares through your vesting period of X years to the point where you could exercise that option grant, and let's say your company's stock was trading at $10 a share. Well, this is good news. Your grant price was $1 a share. That means to buy those shares, you would pay $1, and then you could flip them and sell them on a public market for $10 per share, and you would clear $9, not including tax. And that's essentially what's attractive about stock options. They're granted at a fixed price, and in a in a perfect world, the price goes up after that, or the value of the stock goes up after that, and you create what we call a spread between the grant price and the actual value of a share, and that becomes gain if you exercise your shares and then sell them. So the key to that is the grant price. What price were they granted at and approved when they were approved by the board? Vesting and vesting schedules. To vest means that certain conditions have been met whereby you can do something. So when you talk about vesting with regards to stock options, typically when options are granted, well, they're still an option. And companies frequently put some sort of barrier between the optionee and the actual share. And frequently that's time. So a typical vesting schedule might be something like none of your shares vest for your first 12 months as an employee, and then the remaining shares vest, so you have some piece that vests immediately at your 12-month anniversary, and then the remaining shares might vest over the 3 following years on a monthly basis. So for instance, if you had a stock grant of 1,000 shares and a vesting schedule that looked like what I just laid out, the person who got that grant would vest no shares. In other words, they would have no ability to exercise their stock any of those shares for the first year. Then on their one-year anniversary, let's say 25% of those shares would vest. So instantly 250 shares would be available for exercise if they wanted to do that. And then 1/36 of the remaining 750 shares would vest every month. There on out until at the end of 4 years, 100% of the shares, or all 1,000 of them, would be vested. So that is a typical vesting schedule. That's certainly not the only vesting schedule. When you create a stock plan, which is something we'll talk about later, you typically set out what the company's sort of default vesting schedule will be. But depending on your stock plan, there may be a lot of flexibility around that. So you might say that your employees, your typical employee would vest on that 4-year schedule, but for board members, maybe if they have 1-year board terms, there's a 1-year vesting schedule for their grants, and you can do all sorts of different stuff depending on your stock plan. But that's the concept of vesting schedule. And many of these things are things that need to be tracked in a cap table, which we're going to look at shortly, and that's why I wanted to run through this vocabulary with you quickly, just to get us all on the same page. Let's talk about some of those key stock option elements to track, and this is one of the key things that you're doing with a cap table. Number one, grant date. You have to track when shares were actually granted. Grants typically happen at the board meetings, or there's certainly the grants are approved by boards. There doesn't have to necessarily be a meeting of the board, but short of a meeting, there might be what we call a written consent from the board of directors, which is tantamount to their meeting, but it certainly says that they agree that certain stock grants have been approved for certain employees or entities, and that grant date has to be tracked. Because that grant date is typically attached to a grant price, and you need to track very carefully what grants were approved at what board meetings and make sure you have that, because any time you do any sort of financing at your company, whether it's public or private, every piece of stock, common, preferred, or option that's ever been granted by the company or sold by the company needs to be accounted for very carefully, and where the approval came from and when that stock was approved. So grant date, critical. Number of shares, that's obvious on the face of it. Optionee information, so once again, this might be an employee, this might be an entity, it could be a contractor, it could be a consulting company. Who knows? You need to make sure you have full information for these option holders. And as a practical matter, you'll want to make sure that you have full contact information for every stockholder and every option holder at your company. There are certain times in a company's life where you need to get shareholder approval for things. In this case, you will need to contact, or at least attempt to contact, every shareholder at the company. So make sure that you have that handy. That's something that you definitely don't want to be lazy on when you're handing out option grants. Share type. There's a lot of different option shares out there, or option types, pardon me, out there. There's non-qualified stock options. There are these things called incentive stock options. There can be restricted stock. There's a whole panoply of different stock types out there depending on your stock plan. And those behave differently. They may have different tax consequences for the optionee or for your company when those shares are exercised. I won't go into all those details, but the fact is you definitively need to track what kind of share type. Exercise price, or also known as grant price, etc., needs to be tracked. Vesting start date and vesting schedule. As I mentioned, different classes of stock can have different vesting schedules, and your vesting start date, depending on your company's plan, that vesting may not, it may begin on the first date of someone's employment. It might begin on the first day of the month following an employee's first day. Or it might be some other date that the board assigns. So the vesting might begin when the shares are approved. So that would be on a board, on the date that the board met and approved the grant. So all of these things are laid out in your stock plan, or I would say they should be laid out in your stock plan. Without that, you will be unable to track who owns what shares, where they are in their vesting schedules, etc. So these are key elements to track. Oh, a couple other things, sorry. Option plan. Companies can have multiple option plans. You might have the 2005 option plan, which had certain rules and terms and conditions. Then maybe in 2010, for whatever reason, you wanted to create different terms and conditions and rules of the road for your option plan. So you need to know which shares came out of which option plan. So you need to track the option plan they came out of. And then state of residency. This is another very practical matter. Different states have different rules on securities. And options are subject to both state and federal security laws. And you want to make sure, here's another practical tip, you want to make sure your corporate counsel is really up to speed on the different rules in the different states, because every time you do an option grant, you want to make sure the optionee is qualified to receive that grant and that your company is actually qualified to give that grant. You get in real trouble if you don't have your option plan properly constructed, and you have to track your state of residency to make sure that your plan actually qualifies in each of the states. This is a tricky and annoying and expensive item to stay on top of. Key other equity elements to track. So this is not stock options here, but other kinds of equity. And it also might apply in some instances to options. The sale date. So this would be for preferred shares or common shares if you're selling those shares. Obviously, you need to know the date of the transaction, number of shares, the entity information. Once again, you may have to contact these entities down the road to make sure you have, if this happens to be an institutional investor, no more than just the name of the institutional investor. Make sure you have a contact there, maybe the CFO or someone who manages their stock purchasing programs. Get that person's contact information. If you do it now while the transaction is happening, it'll make life a heck of a lot easier for you down the road when you need to track these folks down. Share class, preferred, warrant, common, et cetera, et cetera. Lots of share classes available out there depending on your company. Share price, certificate or tracking number. So typically when shares are granted in any class of shares, a certificate is delivered to the shareholder. In fact, most plans that I've seen demand that you crank out a share certificate, and that's something that can typically be requested by any shareholder at any time. So you want to track those certificates because frequently they can be something that actually gets sold in a share transaction and traded, and you want to know who has what certificate at what time and who has ownership rights to those shares at what point in time. And also restrictions. So many shares, actually all shares, are restricted in some way, shape, or form, either by federal law or state law or by the charter of your company. And if they're stock options or restricted stock plans, there could be other restrictions piled on top. So you want to know what kind of restrictions are attached to what kind of shares. Okay, and then tracking of all equity types. Make sure you don't leave any of these things out. There are all sorts of equity types out there. Some companies get very creative. Some companies even use a proxy for stock instead of using actual shares. Some companies give restricted stock that's actually stock. It's not an option, it's actually stock, but it may have other restrictions around it. In lieu of stock options, this is becoming more common practice these days. Don't miss any of these or well, you're going to be in trouble. And then one of the things that we do with cap tables, which I promise we'll be getting to very shortly here, is we roll these numbers up. We want to see what are the major classes of shares and how many shares are in those classes. We want to see things like how many stock options have been granted versus what's the size of the pool, how many shares are outstanding, in other words, actually in the hands of shareholders, and then fully diluted, which I mentioned earlier, which is this concept of if all shares were in fact converted, then how many shares could there possibly be out in the world? and then that gives you another way to look at share ownership. So all of these things need to be rolled up in your cap tables. Okay, enough of that introductory stuff, and sorry that went so long, but there's an awful lot of detail to cover here. Let's go ahead and take a quick look at a cap table. I'm going to do a run through this. Let me go ahead and make that a little bit larger on your screen. This is the, let's do a quick tour here. First off, let me shut that bar down. This is a sample cap table summary. And you'll see that it's one of many different tabs. This particular cap table spreadsheet has 5 tabs, and with different details for different kinds of stock, and we'll look at all those in a few minutes. But the summary is important because it gives you the highest level view of your shares. And typically here you're rolling up all of the information at lower levels. So for instance, we're showing, first off, it's always important to have a date, so know when your cap table was last updated. You don't want to forget this, because when you look at your cap table, if you're a company that's hiring or letting go of a lot of people rapidly, then your cap table is changing very rapidly. So you really want to know, when is this cap table good as of? And then we're looking at things such as common stock. So here is another practical tip. Your board will authorize a certain number of shares in each class of shares, typically. And in this case, the board authorized 20 million shares. And as you can see over here under the units, 15 million shares are out to founders, and another 200,000 restricted common shares are also out. So there's a total of 15 million common shares out there, out in the world. And that represents, in this case, 28.1% of fully diluted. So we'll talk a little bit more about that in a minute. But I, as a practical matter, like to understand what percentage of shareholdings of fully diluted shares does any class of stock own at any period of time. Your board might want you to look at other statistics, such as just tell me what percentage that is of the outstanding shares, et cetera. These are all good things to know. And of course, this will be your spreadsheet, or you have your own spreadsheets already, so you can track it however you like. Next class of stock, this is preferred stock. This particular sample company has both Series A and Series B. And you can see how many shares are out in those two series, and then what percentage of the total ownership that is in the company. And then down here, you can see this company has a stock plan, happens to be their 2009 stock plan, and you can see how many options have been granted, and then how many options remain available in what we call the option pool, which I mentioned a little earlier, and we'll take a look at again. This also has a memo item here that says options exercised or restricted stock. These are our options. Once they're exercised, actually typically become common shares. So once they're exercised, they kind of move from this area, area 3, in this example, up into the common stock area. So here you can see those restricted shares, 200,000, but I put a memo here just so that you can total up the total number of shares and have it tally to the total that you would expect out of your total option pool, for example. And then at the end of the day, all of this totals up to your fully diluted shares. And once again, this is on an as-converted basis. So that's the cap table summary. Cap tables are wonderfully simple in one way, which is that no matter how many classes of stock you have, you can just continue adding to this example cap table or your actual cap table with new classes of stock, and just make sure you're tallying them up and adding them to the summaries and the totals. And each class of stock tends to act very similarly. As long as you're tracking all the information behind each class of stock, you'll be a good shape. So let's take a quick tour through the next section of this workbook, which is common stock. And this is a typical stock ledger. So here what you can see is that there are people who hold the shares, and I haven't used names here, we're just using generics. Founder number 1, founder number 2, employee number 1, and under this common stock, you'll see we're tracking not only the name, but the class of the stock, common units, the share certificate number, the number of shares, the effective date, which might be the date that, in this case, if these were founders' shares, this might be the date that the company was founded. For the restricted share, or the exercised options, pardon me, which I mentioned on the summary page, this was an exercise of shares, and you can see the date that they were exercised. You can see the issuance price per share. So these initial common units, and this is common of founders stock. Founder stock tends to be very, very, very cheap. So this is what, 1/10,000th of a cent per. Let's see. I just got a question from someone. It says you have 20 million authorized shares, but your outstanding common plus options exceeds 20 million. Is that a problem? That's actually a great point. That is a problem, and it's funny you point that out. Because I forgot to, when I was throwing this sample worksheet together, forgot to account for some of that math that I put together. So we're updating the common units to 30 million to make sure we account for the 15 million here plus the 8 million here so that we have the full number of common shares. Thank you, Julie, for pointing that out. And I just wanted to hit that while we were talking about common shares. So the founder shares, once again, very inexpensive, and then the actual employee shares, these were granted at 5 cents per, and that's where they were exercised. And then once again, know what class of shares and why they were issued. So these top 2 were founder shares. This next one was an exercised option. These are all things that you will want to know because you might have to explain this to someone later. Like, hey, where did these 200,000 shares come from? Well, I know that was Jane Doe who exercised 200,000 shares, and that's critical for you to keep track of. All right, so that's the common stock ledger, and for most companies of any size, this could go on for pages and pages, or maybe you don't even see it at all. Maybe you're using some piece of software out in the cloud to manage all of your stock options. But underneath that are ledgers like this. They're just databases that track your shares. Now, next, let's look at our stock option ledger. This has a little more in it, and I'll start with the top level here. Once again, we have the holder name. We've got the grant date, the number of shares they were granted, and actually back to the grant date. You'll see that these grant dates come in bunches, and that's because these grant dates typically reflect when board meetings happen. And it's either a live board meeting or it's a written consent of the board. But typically, you might hire, in this case, these first 3 employees were hired on 3 different dates. Actually, this vesting start date for this particular company is the employee's date of hire. So you can see 3 different dates when they were hired, but the board did not meet and approve these option grants until October 1st. So here's a great example of the grant date is different than the vesting start date. And this is very common, can be common. Once again, your company stock plan may reflect some different rules, but just know that this could be how your stock plan works, and you need to be able to manage that. Okay, so that's the grant date. Number of shares granted, that's pretty obvious. Percentage of fully diluted, just to track. So you understand that Jane Doe, employee number 1 owns roughly 1.4% of the company. Grant type. This company only has granted non-qualified stock options. Once again, this is based largely on your plan, which is to what type of options can you grant. Perhaps this company does not allow granting of ISO shares. It's entirely possible. And then here you can see exercise price per share, and that's changing over time as the value of the company changes over time. We're going to talk about some of that stuff shortly. Vesting start date. this is based on what your plan rules say. So in this case, the vesting start date for this company, vesting starts on the date of the employee's first date working for the company. Number of options vested. I'll show you where I calculate the number of options vested in just a moment. But as I discussed earlier, vesting schedules may vary based on who's getting the grant and also based on your stock plan. It's good to understand just from a practical perspective, if you're the CFO of a company or whoever is charged with tracking all of the company's shares, how many shares do we have completely vested currently? So let's say the company were to go IPO tomorrow. Well, how many shares are vested? How many shares might our employees exercise? Good to know this. So number of options vested, and then right next to that, simple math, the number of options unvested. Options canceled. Typically, options get canceled because, well, the most common case I've seen is someone gets let go or they leave the company before vesting occurs or before they've exercised vested shares. So their entire grant would be canceled, and then just in order to sort of track full circle what's going on with an option grant, you would show the number of shares that were canceled here. So if employee number 3, John Doe, was let go, we can see they have a grant of 40,000 shares originally, and we would show 40,000 options canceled after they're let go. So you want to track all those canceled shares. Here you can see exercised options that Jane Doe, first employee, exercised 200,000 of her options. And then you can see how many options are outstanding. So that's typically the number of shares that were granted. For Jane Doe, she was granted 750,000 shares. She exercised 200,000, so she now owns those shares, common stock for her. And then she has 550,000 options outstanding, of which she can exercise 206,000. So remember, she had invested in 406,000 of those original shares. She exercised 200,000, so she could still exercise another 206,000 if she wanted to. So outstanding exercisable shares, also good to know. State of residency, I mentioned the import of tracking this earlier, so make sure that you're tracking that for all of your employees, and country of residency if they have to be outside of the U.S. Different countries have different rules around shareholding, and that's a whole different kettle of fish. It's really fun to work with. But make sure you understand that, and if you do have employees outside of the U.S., you and your counsel should be tied at the hip and make sure your stock plan accommodates that, and that stock grants are actually legal in whatever jurisdiction you are trying to grant them. A little housekeeping I find to be handy over on the right-hand side, which is a couple pieces of paperwork. Do we have the employee agreement, the consulting agreement, whatever the agreement is that ties us to this person? And typically that's an agreement that calls out how many shares that person will get as options. You want to make sure you have and know where that document is so you can refer to it. So presumably Jane Doe's employment agreement noted that she would get a grant to be approved by the board of 750,000 shares. Make sure you've got that document. When you grant options, there's typically an option agreement where an employee needs to acknowledge that they've received this option grant, etc. Make sure you've got that. Has a board consent been signed? This could get you into a lot of trouble if you don't have a signed board consent or minutes from a live board meeting that show that each of these grants were approved. If you don't have that, then according to the laws of most states and countries, there hasn't actually been an option grant here. So this has gotten a lot of companies in trouble. It's certainly gotten a lot of CFOs in hot water. Make sure you've got all the documentation, and I track it on the cap table itself, so it's highly visible when you do or don't have these things. Vesting schedule. Know what the schedule is. As I mentioned earlier, there are some very common vesting schedules. This one happens to be 1 year cliff, as we call it, which is to say nothing vests until the 1 year anniversary, then 25% vest on that anniversary, and then 1/36 of the remaining thereafter until 3 years are out. but this can vary based on the kind of option being granted or who you're granting it to. So in this particular example, we've got a couple of different option schedules, and you can see that this, and here's one other thing I need to, and I apologize, need to update. This is actually an advisor grant. It has a different vesting schedule. This is ratably over 12 months, and I will update this to actually say advisor number 1. And I'll make sure this is updated before we send it out to you today. As you can tell, this is the first time I've given this particular presentation, so my apologies. And then you'll see, continuing over to the right, I have this wonderful little schedule where I actually, in a very detailed fashion, track the vesting of every share granted. So we'll take Jane Doe for starters. Jane Doe's grant came on, her grant date began her grant date, pardon me, was October 1st, 2009, but her vesting date was May 1st, 2009, and she's on the one-year cliff. So you'll notice she doesn't have any shares begin vesting until May of 2010. 1 year later, she gets that cliff, 25% of her shares in this cell right here that shows 187,500 shares. Then she has this schedule going out 36 months, showing 1/36 of the remaining shares until she's done vesting, which will be in May of 2013. So that is how I track who's vested what shares. And then you'll see down at the bottom I have totals. So in any particular month, you can see what shares are being vested. And you can total these up. And this is what I have done back in the this area on the cap table. Under number of options vested, I have a date, and I simply update my sum schedule to go through the date that the options are vested through. So in this case, I'm looking at all options that were vested through July 1st of 2011, and that's this list of options and this total, 2,000,004 option shares. So that's how you track what options have been vested. I find CEOs really love to know how many options are actually vested currently, so that's a great thing for you to track. So that is a stock option, your typical stock option ledger. So everything you need to know about every stock option grant, where it sits, what's vested, not vested, canceled, exercised, outstanding, and all of that other administrivia that you need. Now down here, I've got a little area where I'm tracking the option pools. So typically when certain events happen, stock option pools might be created. This happens to be a cap table for a privately held company. They've done 2 series of preferred fundraising, and typically when those rounds of capital are raised, these stock option pools are created and approved by shareholders. And in this case, Series A approved a 3 million share pool, and the Series B approved a 5 million share pool. 4.1 million shares have been issued, and that leaves roughly 9 million shares in the pool remaining to be granted. So we'll talk in a little more detail about that in a minute, but let's look at how we track a private series of shares. So this is a tab for the Series A for this particular company. They closed this round on December 31st of 2009. Just prior to closing this round, there were 15 million common shares in the company, so that exercise of 200,000 shares hadn't happened yet. There had been 2 million options granted prior to this round of funding, and the new option and the board, and usually in some sort of negotiation with the investors, the lead investors for a round, they determined that they wanted to create a new pool of 3 million shares, so that they would have at the time, 10% pool of shares out of the fully diluted in order to grant to new employees. And this is very common. And this whole new option pool thing is really a negotiation. And existing shareholders want this to be small because they want the, as little dilution as possible in their existing shares. And the new shareholders want this to be big because they want the old shareholders to take any dilution of new shares before they put their new money and get their shares out of the company. So that pool was created at the seed round. You had this 20 million shares. Also, a negotiation is valuation. We're not going to get into that in this conversation, but a value is put on the whole company, and then you do the math and say, okay, well, if the company's worth $5 million and there's 20 million shares, then that's 25 cents per share, and then that's how new shares get created in a company. A price, a value is set on each share in the company. Your investors, in this case, investor 1, 2, and 3, decide I'm going to invest X dollars in the company. And then in this case, you would divide this amount of dollars by 25 cents a share, and this is how many new shares are created. So poof, out of thin air, and with a whole bunch of paperwork and some expensive lawyers, you've just created new shares in this company, which you are now tracking in your cap table. So congratulations. These shares now get pulled forward to the front of your cap table into the summary, and you're tracking them along with all of the other shares. Here's a Series B, sort of same thing, different day. This is a little further on in time, so we have some more common shares. We have the Series A shares we're already accounting for, but this will give you some of that math. So if you happen to be in a private company and you're tracking shares, hopefully this will be helpful to helping you understand how dilutive around the financing will be, how many shares your company will be creating, and whether you're public or private. When you need to create new shares, you're creating new shares out of the ether. Maybe you need to raise money in a secondary stock offering as a publicly traded company. You're just going to create those shares, once again, out of thin air with a whole bunch of paperwork, and then sell those shares to a new class of investor. If you're a publicly traded company and you're hiring new employees, you need an option pool to be able to grant shares to those new employees. So these things, the mechanics are actually virtually identical between privately held companies and publicly traded companies. Just your stock plan might be different, and how the shares are priced might be different. And we'll take a look at that shortly. So that is the quick tour of the cap table. We've got a whole lot of other things to cover here quickly, so I'm going to hop back to our presentation and quickly move on. So we've hit the tour items. I'm going to hop into the other fun stuff section. Build equity tracking into your forecasting. This is very simple to do. Make it part of your core business model. Now, if you have business models in Excel, all you have to do is add a column that is equity shares for each expected new employee that you're going to be hiring. And presuming your forecast, tracks things, employees, one employee at a time, or groups new hires, you can very easily add the math for how many shares you'll be providing to each employee as you hire them. And now understand that major hires consume the most stock options. A VP of marketing at a startup company might get 1 million shares, whereas a marketing manager might get 40,000 shares. Your company typically should have guidelines around these stock grants. So when we hire someone at a manager level, we'll give them X number of shares, et cetera. You build all of that into your business model, and then what you have is an equity plan by function, by level, and it goes into the future. So that helps you understand how many shares you will need in the future to grant, and that tells you how big your equity pool needs to be, your option pool, pardon me, needs to be. So you can easily build this into your forecasting model. Now that's if you're tracking in Excel. Now, if you have certain other forecasting platforms, some cloud-based platforms will actually allow you to create custom fields. I highly recommend creating and tracking this because option pools are something that you don't want to think about in 30 minutes while your CEO is standing over you and you're negotiating your next round of capital. It's something you want to keep an eye on so you'll know, oh, you know what? According to this plan, we're going to run out of shares. We won't be able to grant any new options to people in 6 months. Well, we better start talking to the board about that and creating a new option pool. So build it into your forecasting. Calculating an option pool. I'm going to hit this one really quickly because we've already touched a couple of things. First off, know how many shares remain in your existing pools. Then use your budget analysis and your forecast, as we just discussed, to understand how many shares you need to get to whatever that next thing is. For private companies, the rule of thumb is create an option pool that's big enough to get you to your next round of funding. That's when you'll carve out more shares and create your next option pool. You really don't need to go beyond that because your option pool is going to be renegotiated at that time anyway, and you don't want to take more dilution than you need now. So understand when you think your company is going to raise that next round of capital, or for publicly traded companies, when's that next corporate milestone? When's another good time to go to the board and say, you know what, we're at this next period of growth. We're going to need to create another 5 million shares for our option pool. Here's our plan. So take all of that into consideration. And realize you're going to be adding all sorts of fun factors to this. So you might say, look, we've got 1 million shares in the plan. My model says we're going to need 2 million more shares before we get to this next milestone. And then you and your CEO, your board, perhaps existing investors will say, well, do we really need an option pool of 3 million shares? Maybe we just create 2 million shares at this point. So it's all a discussion and a negotiation. But just be prepared with your data. Analyzing future equity transactions. I ran you through a bit of that. I'm not actually going to go into that right now because we've got a bunch of other things that we want to cover. But there's this whole idea of valuation. There's pre-money, there's post-money. What is dilution? How does that happen? Well, dilution happens when you create new shares out of the ether. We've already mentioned that a couple of times. It's great, even if you're not the CFO, it's great to just understand this, because when new shares are created, existing shareholders get diluted. And that means that existing shareholders now own less of the company than they owned before. So you want to understand the mechanics of that. I've got some examples in here that'll make it easy for you to understand that. Let's see. Automating option tracking. A couple options for this. Number one, a lot of law firms will do this for free for their clients. That makes sense up to a certain size. Once you're a certain size company, you'll probably bring on full-time stock administration, and then you'll have, that person will either use, inside software or software available through the cloud, something like that. Very large companies tend to do it in-house, but small to mid-sized companies, very frequently your lawyers will offer to do it. And that's a nice, easy thing to do. I happen to not like that as a CFO because then I'm one step removed from all of our shareholdings, and I like to be closer than that, but certainly an option. There are a number of other kinds of firms who will do this. I mentioned law firms. Some accounting firms will do this for you. There's some specialty firms that do nothing but this kind of thing. They'll track you and manage your equity plans for you. In a lot of ways, that can be really handy. Big headache, takes a lot of work. These options are out there for you, and they'll typically charge you either a flat fee basis annually, or they'll charge you per participant in the plan, and there may be some upcharges based on complexity of your stock plan. There are a number of software platforms that can help you with stock plan tracking. Equity Edge, which is now owned by E-Trade, the platform called eProsper, it's now owned by Silicon Valley Bank. Equity Edge tends to be used by larger companies. eProsper tends to be used by venture-backed smaller companies. There's some other platforms out there. There are some of these platforms cropping up in the cloud, which is handy. So just know that these things are out there. There are a lot of options other than Excel for you to look at. Under details, which is the last section here, the stock plan creation and approval by the board and shareholders. Your stock plan is sort of a core element here. Make sure that you've got one in place. Read it. Understand that they're actually pretty simple. They only have a handful of elements, typically around things like vesting and restrictions and exercise of options. You really need to know that. Option grant pricing. For public companies, the grant price is typically the value on the date that the options were approved by the board, so that there's no monkey business around people trying to manage grant prices. For privately held companies, there's this valuation exercise called a 409A that you need to get done, and talk to your counsel or your accounting firm about that. Only a board can approve option. Well, the plan is actually typically approved by shareholders and the board, but grants only by a board. and make sure you have that documentation or you will get in trouble. And never delete or toss anything. People really care about the shares that they own, and you don't want to have option documentation go missing or preferred stock, sale documents, etc. Just be very careful about tracking them. And even when it comes to tracking via spreadsheets, don't throw out your old spreadsheets. Just version your spreadsheets every time you make a change, so you can always go back through history and see what happened when. Last up, Proformative resources. If you have more questions, we've had a number of discussions and a number of expert questions on cap tables and 409A. So you'll see here there's, on 409A there have been 15 expert questions, 11 discussions. We have 4 experts who can actually speak to 409A. So if you've got more questions, there's a bunch of stuff on Proformative that will help you come up to speed on that. And I've got a couple links that will be embedded in this presentation, which you will get links to the valuation experts on Proformative and valuation providers if you need that. These are all just, free services provided. Well, getting to these people and this knowledge is free. The valuations themselves, of course, you'll have to work that out with the providers, but there's a lot of useful information on Proformative. And speaking very quickly, that's it. Thank you so much, everyone. That's just an awful lot of information. I appreciate your hanging with me. I realize we didn't get to any questions. If you have any questions, feel free to throw them into the question area right now, and I will follow up with you later after this event. We'll make sure the questions get answered. As to the folks who said, how do I get CPE credit, I've got your email addresses. We'll have Tanya Walsh, our event manager, reach out to you. We'll get you all of that. And lastly, we'll be sending you a survey. I realize this was a little rushed, and frankly, this is my first time going through this, and I created all the materials, but they're far from perfect. So let me know how I and we can do this better next time, because we want to do it better next time. Thanks, everyone. Appreciate you taking time out of your busy day. Hope to see you on Proformative, and take care. We'll either see you at our next event or online. Have a great one.